in the Japanese stock market today. This is what happened in the Taiwanese stock market today. This is what happened in the British stock market today. And this is what happened in the American stock market today. All around the world, stock markets took a tumble, and almost every single big stock took a big dip. Well, except for one, but we will get to that. But let's start off with where this stock market collapse began, and that is in Japan. You see, Japan's stock market didn't just have a bad day today, but it had its worst day in almost 40 years. In fact, it crashed worse today than at any time during the pandemic. The only other time it was worse was Black Monday in 1987, an infamous day when the world lost trillions of dollars in the stock market in just a few hours. But why did this happen today? Well, there are a few hypotheses. One is something called a carry trade. You see, Japan over the last few years has actually kept their interest rates low and have experienced very little inflation. And so, what a lot of very big corporations and Wall Street firms have been doing is borrowing tons of money in Japanese yen with low interest rates, and then taking that money and investing it in other currencies and stocks of other countries like in Australia and the US that have much higher interest rates. Pretty much meaning these large investment firms borrowed cheap money in Japan and have been using that debt to invest in the United States. And it's estimated that between 5 and 10% of the entire American stock market is on this kind of carry trade. But what happens when that cheap money from Japan has their interest rates go up? You see, Japan has not raised their interest rates since 2007, meaning that they have been a safe bet to borrow cheap money for nearly 2 decades. But in March, Japan raised its interest rates for the first time, and they did so again just 5 days ago. Meaning that now all of the Wall Street firms and financial institutions that have been relying on Japan's cheap borrowing cost now are worried that their payments will go up on their debt, or that they will no longer have access to cheap money for future investments into the stock market. And one person who may have actually seen this coming is the renowned investor Warren Buffett, a man who has been known for outperforming the stock market for about 70 years. Well, he decided to cash out pretty much immediately after hearing this news out of Japan. Now, this could have been a coincidence because he has been cashing out slowly over the last 12 months, but 4 days ago, he nearly doubled his cash position, meaning that he expects some sort of market correction or collapse in the near future. And that brings us to the next point about why the global stock market appears to be showing signs of collapse right now, and that is fears of a real recession. You know, one of the interesting tidbits I always bring up is that after World War I, the world was expecting to experience something like the Great Depression. Essentially, something terrible was supposed to happen after the war, and the Spanish flu decimated the world population and global industries. And one somewhat brief recession did happen in 1920 and 21. A single-year recession that was fairly quick but also a very large downward spike. But then, after this downward spike, the world experienced what was called the Roaring Twenties, a time when we hear about the glitz and glam and wealth explosion that everyone got to experience. But in reality, only the top half of the wealthiest people got to really reap the financial rewards of the Roaring Twenties, because asset prices began to skyrocket and debt was very cheap to borrow. But if you were a lower middle class person or were working as something like a farmer, then you actually lost ground during the Roaring Twenties. But hey, as long as the people who owned assets got richer, that's all that matters, right? Anyways, what followed after the Roaring Twenties was the Great Depression, the worst and longest economic downturn in modern history. A horrible economic decade that essentially needed a world war to take the world out of this economic downturn. And now, today, investors fear we may be following a similar pattern. We experienced a brief and sharp downturn in 2020, then asset prices skyrocketed for the better part of 3 years, and now there are some fears we might be heading into a very long recession. Now, if you follow this channel, you know that a lot of countries like Canada and Germany have actually been in a GDP per capita recession for a few years now. However, high immigration numbers are making the total GDP increase, therefore governments and Wall Street are able to say that the whole economy is growing and everything is fine and dandy, even if it means that the average person is actually losing economic ground. However, there are other signs of a looming recession. Unemployment in the USA keeps rising, and job creation keeps falling. In fact, the unemployment rate is actually the highest it's been since the pandemic started. And this is important because of something called the SOM rule. It's a fairly reliable recession indicator that indicates a downturn if the 3-month moving average of the unemployment rate rises by half a percentage point from its low in the previous year. It's a mouthful, but essentially, if unemployment keeps steadily rising, a recession almost always follows. And that appears to be something that is happening right now in the United States. There's also another indicator that has been flashing signs of a nearby recession, and that is government bonds. An inversion yield curve occurs when the interest rate on the short-term US Treasury notes exceeds that of long-term Treasury bonds. Normally, long-term bonds have higher yields than short-term ones due to the greater risk over a longer period. However, during periods of economic uncertainty, investors prefer the safety of long-term bonds, leading to higher demand and lower yields on these bonds compared to shorter-term ones. Now that is all a mouthful as well, but essentially all this means is that investors seem to think the USA has a lot of uncertainty in the economy right now, and these investors demand a lot of return in order to invest in short-term bonds because they view it as a very risky investment. So, the near term seems risky and the long term seems relatively okay. Another sign that is pointing to a looming recession is actually from the people themselves. You see, in the USA, what percentage of the American economy do you think is from consumer spending? Is it 20%? 30%? 50%? Well, it's actually about 70% of the entire American economy. And so, when people spend less money, a recession is more likely. Recently, consumer spending has been steadily increasing, but its increase has been slowing slightly over the past few months. But the more important thing here to note is that even though consumers are spending a little bit more, this is also coming at a time when debts and bankruptcies are also skyrocketing for these very same people, meaning that consumers seem to be spending more even though a lot of the spending is coming in the form of debt. And if economic conditions get poor enough where the average American can no longer afford to pay back something like their mortgages, well, then we have the 2008 financial crisis all over again. Now, those are just the recession fears, but there are also a few other very strange things going on right now, and one of which could be a major concern going forward. First of all, the VIX, which is a volatility indicator in the stock market, has spiked to such a high that the only time that it was higher was when the pandemic started and they announced the virtual shutdown of the entire economy. So that number, that volatility number being so high is a very worrying sign that investors are extremely uncertain about the stock market's future in the near term. But one thing that kind of started this video is actually one company that skyrocketed in valuation over the last 24 hours or so when all of the global markets were melting down. What was that company? That company was Lockheed Martin, the largest military company in the world. Initially, Lockheed Martin stock rose by over 20%. Signaling that some investors somewhere began to see a lot of value in investing in the American military. Now, eventually that stock did fall down back to earth, but it brings us to the next point, and that is that there is a fear in the financial markets that there will be a war. You see, the war in the Middle East is showing some worrying signs lately, one of which is actually Turkey. Turkey's Erdogan stated last week about how he could send troops to help in Palestine. And if Turkey were to send troops on the ground, that could be seen as quite an escalation for the war that may see a response from Israel's allies, including the United States. Turkey also recently started showing a pre-war sign by blocking social media apps like Instagram just a few days ago to control online information. And as of a few hours ago, news reports have been coming out about how an Iranian attack on Israel appears to be likely. And this comes after Israel assassinated one of Hamas's leaders. So depending on the Iranian attack, the US and the Western powers might get pulled further into the war in the Middle East, and the odds of the war escalating appear to be much higher than they were just a few weeks ago. That's not even mentioning the war in Ukraine, which hundreds of billions of dollars are still being poured into by the United States government. And that brings me to one last thing. A ticking time bomb that appears to be getting more attention as of late. And it is something that I talk a lot about. And that is the US government spending. Right now, we are at a point in history where 30% of the federal budget is being paid off by taking out debt. And in fact, a lot of that debt is getting created to pay off previous debt. And that debt was taken out to pay off previous debt, and so on. Right now, the government is on track to actually run out of money pretty soon. In fact, every 100 days, the US is adding $1 trillion to the debt, and it's only getting worse. Programs like Social Security, which were put in place when the average person would live to about 64 years old, well, they are now being put in place to pay off the average person who is living to nearly 80, meaning that Social Security is paying significantly more per person per year. Social Security is also currently the largest expense of the United States government, taking up 22% of the American budget, and the program will likely have to change or shut down at some point within the next 10 years. Now, the USA, along with many other countries in the world, seem to be adopting this thing called a modern monetary theory, also known as money printing. Essentially meaning that you don't have to care about debts anymore as long as you keep increasing the money supply. And this is worrisome because, as someone who has studied history quite a lot, one of the key signs of a dying empire right before it falls is these two exact things: not paying off debt and increasing money supply. I mean, Rome literally tried modern monetary theory near the end of its empire while taking on tons of debt. And yet, modern economists think that because of reasons X, Y, or Z, that this time it will be different. But certainly, if history tells us anything, it's that the debt will come due and the entire system could come crashing down if we do not correct it soon. And that is a major concern that investors have today. It's that at some point, the American economy will no longer be able to withstand these massive deficits year after year. And that is why there is a big fear about what will happen to the American empire and everything that resides within it. But for now, I encourage everyone just to be safe with your money. Do not do anything stupid in a time of volatility. And who knows, maybe this thing will pass. I mean, there have been a lot of downturns in markets over the last